So they wrote yesterday in a note, economic contraction, stimulus, and central bank balance sheets are going to push investors into gold, and they're looking at the 3,000 over the next 18 months. Francisco Blanch, BofA Securities Global Head of Commodities Research, joins me now. Francisco, I got to be honest, I read the note 3 times yesterday because I couldn't believe you actually made a call for 3,000 in 18 months. I was covering gold 10, 15 years ago, and I would have never heard that kind of call. Walk me through more your thesis about why you made it.
Well, the core of the thesis really is that central bank balance sheets are going to double, fiscal deficits are going to double, and we are going to find ourselves with a lot of debt being effectively socialized. And we haven't had this situation for at least the last 10 years, where central bank balance sheets as a share of GDP have been relatively stable between 21 and 28% of GDP, which has been also a stable period for gold prices. But now we see this ballooning of central bank balance sheets and fiscal deficits, and gold is the ultimate safe asset. It's the only part of the central bank's balance sheet that has there's nobody else's liability, essentially, and everything else that they hold is someone else's liability. Is your mortgage or a piece of somebody else's security, or a piece of a pension fund liability. So or a pension fund asset. So essentially, gold is we still view it as a core part of the monetary base, and that's why we think it will go up in value here.
So does that mean that you see monetization, basically, of all the debt, like central banks just basically just buying all this debt from governments around the world? Is it that simplistic or not?
Well, I mean, if you think of monetization as rates essentially being at zero or close to zero for a very, very long time on a nominal basis, and inflation being at 2-3 percentage points for a very long time on a nominal basis, right? So effectively, I'm saying that real rates are going to be negative for a very long period of time, and well, if you view that as a monetization, then you can call it that, but essentially, what we're saying is that real interest rates are just going to be in negative territory for many years to come, and that's what's going to drive the gold price a little higher. That's how we think about it. But you could say monetization, because negative real rates essentially means that if you have your money in a bank deposit or you have your money in cash, you will lose money over the next 5 years.
So based on that, then how do you wrap in then inflation versus deflation? Because over the last 48 hours, as we saw oil go negative, now the conversation seems to be a deflationary one, as break-evens across the board, particularly short-term, just get dragged down. How does gold perform in that kind of environment?
So gold tends to get dragged down, and in fact, if you looked at what happened in March it was a deflationary conversation. We had the Russia-Saudi Arabia price war, which led oil prices down pretty quickly. Then we had COVID-19 leading to lockdowns, which led to a collapse in demand of maybe 25% this quarter, which is really what's ultimately led to a massive increase in inventories and for oil prices to go negative at the beginning of the week. And that's ultimately dragged down those break-evens that you were referring to. But the Fed has also been exceptionally fast at responding to this market environment. The Fed has never really been this fast before. Within 18 days, they did more work on their balance sheet and on trying to support both asset values and consumer prices than they did in 6 months in the financial crisis in 2008. They had all the tools ready, and they just pulled the trigger. So that's why we've seen equities at 2,800 on the S&P. That's why the volatility of equity markets has come down a lot faster than we anticipated using historical models, and that's ultimately the reason why we, despite what's effectively major economic carnage, we are seeing normal values on the screen, and we are seeing support to both investment grade and even high yield bonds, as well as equity values, because what the Fed's doing. But the Fed cannot buy oil, and the Fed cannot print gold. So as a result, we've had negative oil prices, and we think gold's going to shoot up here. That's the bottom line.